Hi, everyone. The stock market is prone to wild swings, and this year clearly has been no different. I'm Brian Boyd, and I hope you had a really fun summer. Today, we're going to do a mid year recap, even though I realize we are well past the midpoint. We'll check in on asset class returns year to date through July and look at a couple other data points that I think you'll find interesting. So let's get started. Looking at year-to-date returns among the major asset classes, you can see international markets have dominated so far this year. I'm not going to lie, there are times people question our intelligence for owning international stocks in our portfolios. So it's good to see them doing well, roughly 18% a year each. A diversified portfolio, little benchmark here of 60% stocks, 40% bonds, 8.65% year to date through these numbers are through July 31st. And US stocks lagging their international counterparts at about 8.59%. Most everything is beating cash, which is this 1 to 3 month T-bill at 2.5. We do have some laggards over here. No surprise, the interest rate sensitive sectors of the market, real estate, U.S. small caps lagging, particularly with the Fed slow to cut interest rates. Wanted to highlight international equity returns relative to US. I joked a second ago that we get questioned for owning international, and that's because the US has really dominated. So the blue bars show the years in which US has dominated, and certainly recently, with the AI boom and tech and the Magnificent Seven, the US has done extremely well, particularly relative to international. But there are long periods of time historically, decades even, the decade of the 2000s, where international I'm colorblind, I think that's orange, have outperformed US. So it is good to see that year to date, international is additive to portfolio returns, outperforming US large caps by about 9.4%. You can see U.S. core bonds up about 3.75. That's the U.S. ag. One thing to note here, and it's not shown on here, is Cal Munis and even national munis in general are having a little bit of a tough time relative to the core bond category. And that's for a couple reasons. So reason number one, 2024 was an election year. And as voters, we voted new spending for counties and municipalities. So there was a flood of new municipal bond issuance that the market is slowly absorbing. So year to date, the Vanguard California Intermediate Term is up about 1.15%. Second reason, municipal bonds have underperformed. Quite a bit of selling during tax season. High net worth investors are selling their munis to pay their tax bill. But we also saw uncertainty in the municipal bond market from tariff uncertainty, economic uncertainty, credit quality based on the economic uncertainty that was going on. So I do think that this divergence between munis and taxable bonds, the core bond, will be short-lived. And one of the reasons I think that's the case, if we take the Vanguard California Intermediate, as of July 31st, it was yielding 3.63%. And if you remember, Cal Munis are exempt. The income is exempt from both state and federal income tax. So if you are in a high tax state and you're in the top federal income tax bracket, you would actually need to earn 7.91% in a taxable bond to yield the same as a 3.63% in a muni. So super attractive. I think money's going to continue to be flowing into that asset for that piece of the portfolio. These are high quality bonds. If you move into the high yield space, riskier space of the market, yields on the American Century High Yield, California as an example, 4.58%, which is equivalent to a 9.99% taxable yield. So wanted to point that out. Those who own municipals, particularly California municipals, it's been a detractor to portfolio performance, but I would expect by the end of the year, particularly if we do get some rate cuts, that dispersion will narrow. Moving on to the year that has been, I wanted to highlight for all of you steadfast investors, what a tough beginning of the year it was. So this is the maximum drawdown, how much both the S&P 500 and that 60 stock 40 bond benchmark was down. So on April 8th, the S&P was down 18.76% at its maximum, with the 60/40 down about 9.77. So it was nice to see diversification work in that instance. The average, if you followed us for any time, you know that the average intra-year decline of the S&P 500 is about 14%. So it is normal to go backwards, even in a positive finishing year. And we certainly saw that in spades with almost 19% drawdown year to date. So it's too soon to tell how the year will finish, but these types of downturns, particularly amongst political uncertainty, and if you think about what was going on in March and April with tariffs, and is this going to be a new world order? Are tariffs being used as a negotiating tool? Are they going to crash the economy? We got some clarity on that. We're still getting some clarity on that, and the news has been significantly positive. So moving on, if we just look at the recovery since April 8th of 2025, the S&P is up through July 31st, almost 28% from that bottom. And just reinforcing the reason why, unless there's a data-driven reason to reduce risk in your portfolio, don't touch your portfolio during those tough times, because the best market days typically occur immediately after. And you know us, we stepped up our communication in March and April, encouraging you to stick with the plan. Future is always uncertain. And that proved once again to be a super positive decision to stick with it. Even that 60/40 diversified portfolio is up almost 16% since the lows. Close on some curious news, I think. One of the quantitative data points that we look at is the economy. So don't worry too much about this chart. It's really a chart only a quant nerd could love. But what I want to highlight is, of these 12 different indicators that we track, we just kind of track their trend, right? Is the economy improving? Green means good, red means slowing, white is pretty neutral. And then we put a trend line in here, and you can see, going back to January of 2024, that trend line is deteriorating a little bit. Had a little recovery in February of March this year. And then with the tariff uncertainty, we did see the economic data deteriorate in both June and July. So I think August economic data, which we'll get September 1st, have this same amalgamation, I think will tell a lot. Was this just a short-term deterioration based on the uncertainty, again, around the new administration and tariffs, or is this a longer-term slowing of the economy, which could impact how we use risk management, your portfolios. So I wanted to highlight a couple of those things. I wanted to wish you a great rest of the summer and a great fall, and appreciate you watching. See you soon.